Hello, it's Jeffrey Christian. It's Friday, the 4th of November. It's about 9:45 in the morning here in New York. Gold and silver prices are up relatively sharply today, having been down sharply yesterday. I want to talk about why commodity prices, including gold and silver, are lower right now. It seems to have confounded a lot of people, although it probably shouldn't have. I'll also talk about silver inventories and how declining silver inventories don't necessarily presage higher silver prices. Silver inventories don't dictate silver prices, but again, you're seeing a lot of people say that they do. And, in both of these topics, there are a lot of people who are less intelligent and less informed than they probably think they are. I'm pontificating about these things, and it's confusing a lot of people. So let's delve into some of the details and actual data and information and what really works here. Gold and silver prices are lower. We've talked about this. They're lower than we thought they would be. We had thought that they would fall in the middle of the year and probably be rising a little bit by now, but they're not. They seem to be forming a base, but they're still vulnerable. There are any number of people who had been talking about $2,000 or $10,000 gold by this time, and now they're talking about $1,200 gold. They'll probably be just as wrong on the downside as they have been on the upside. And there are a variety of reasons for that. A, they don't understand the precious metals markets. B, they believe things that aren't true. C, they don't understand basic economics. What's really going on here is that interest rates already have risen higher than people, including CPM Group, thought they would 3 months or 6 months ago. And those higher interest rates and the monetary policy behind them is really what has caused gold prices and silver prices and other commodity prices and other asset prices, stocks and bonds and foreign currencies, non-US dollar currencies, to be lower than a lot of people thought they would, including CPM Group. Yeah, it's those higher interest rates that really are at the risk of it all. Now, inflation on the left-hand chart here is high. It's as high as it was. No, it isn't. It's higher than it was for many decades, and it hasn't gotten as high as it got in 1974, 1975, nor in 1979, 1980, but it is high. And a lot of people looked at that and said, well, gold and silver investment demand should be strong, and gold and silver prices should be higher as a consequence of this high inflation. But what's happening is that the financial markets are looking at the high inflation, and they're listening to what the Fed and other central banks are saying and doing. And the major consequence of the high inflation is higher interest rates, which will mean, and probably even higher interest rates, and lower economic growth, and ultimately, at some later point, lower inflation. The financial markets expect the Fed to succeed. Gold bugs and gold promoters may not. So if you look at the financial markets, the broader financial markets, if you go to the CME FedWatch site, you'll see that the consensus for a couple months has been that you would see a 75 basis point increase in the interest rates this week when the Federal Reserve's Open Market Committee met. And that's what we got. And that's been the consensus in the broader market. And it's been reflected in lower commodity prices, lower gold and silver and stock prices. You listen to the promoters in the gold and silver market, And they were saying, oh no, the Fed is going to fail. The Fed can't control inflation. The Fed would throw us into a recession if they tried to do that. And therefore, the Fed has to pivot and start lowering interest rates in November. And some people, unfortunately, believe that. No credibility, no accuracy. The reality is that the broader financial market looks at what the Fed is doing and listens to what they're saying, and they're saying the Fed's probably going to succeed. It can probably quell inflation or help reduce inflation, get to that in a second because it's very important, without triggering a recession. So the markets are betting that the Fed succeeds. And the gold pundits say the Fed can't succeed because we gold pundits are smarter than the thousands and tens of thousands of people involved in monetary policy creation and financial management. And we know that the Fed has to fail because we've been saying this for decades. So it's got to come true at some point. Now, there's a very important thing about inflation and monetary policy. And one of the things that I would say is too many people focus too much on monetary policy. And they ignore fiscal policy, and they ignore the fundamental supply and demand conditions in the economy. And those two sets of factors have been much more important in fueling inflation than the monetary policy. The monetary policy has been accommodating obscene fiscal policy for decades, since the 70s at least. And it's been trying to maintain a balance in the economy in the face of very substantial fundamental supply and demand imbalances in the broader economy. And those are the factors that have been driving inflation. And raising interest rates can help moderate the inflation, but because it's the fiscal largesse, obscene largesse, and major changes in the structures of the underlying real economy that have been fueling inflation, the Fed can only do so much. And we've talked about this for decades. The Fed can stanch the bleeding in crises, but it cannot stimulate growth. Right? You have major fiscal problems. You have major imbalances. You can look at almost any sector of the real economy and find these imbalances between the supply and the demand. In the housing market, you have very high prices, and now you have high mortgages. That has caused a massive decline in the purchases of houses and residences. But there's a structural issue that's been going on for decades. If you look at the three groups who want to buy houses, there are people looking for starter homes. There are empty nesters looking to downsize from larger homes to smaller properties. And there are investors who are gobbling up and paying high prices for properties that they will then turn around and rent. Right? Those first two groups are being underserved by the suppliers of housing, the construction industry. These guys want to build large buildings, 3,000, 4,000 square feet and even larger. For decades, the average size of a house in the United States was 1,400 square feet. Now it's about 2,200 square feet. So houses have gotten larger in the last 20, 30 years. But the housing industry wants to build even larger things. And you have this imbalance, which is causing higher prices for housing because it's not meeting them. And then you have these institutional investors who really want to gobble up all of the properties and rent them out so that the United States ceases to be a place where you have, 30, 40% home ownership. And it's much more like Western Europe, where you have most people renting housing and the residential real estate is owned by private equity shops or banks or institutional investors. And there's been a conscious effort on the part of wealthy individuals in the United States to move the U.S. housing market in that direction. That's just the housing market, but you can look at transportation. road transportation, railroad transportation. You can look at the agricultural industry, semiconductors, pillows, socks, restaurants, and you find structural imbalances between the supply and demand in the real economy. And that has been a major factor fueling the high inflation, which has been triggered by the pandemic and economic lockdown and recovery, and fueled by fiscal irresponsibility on the part of both Republicans and Democrats. That's really the root of inflation. The Fed is trying to fight that, but it has said, going back to the mid-1980s, Alan Greenspan in his Humphrey Hawkins testimony would say, look, we can only do so much in terms of trying to help the economy. It really needs fiscal responsibility. And the Congresses and the administrations ever since that time have really broken their responsibility to the society. And it actually goes all the way back to 1968 when Richard Nixon famously said, I am a Keynesian, which he misrepresented, and I know that we can run deficit spending for a long period of time. That's not what Keynes said. Keynes said that if you get into a recession, it's okay for governments to run deficits to get us out of the recession. Starting with Richard Nixon, the U.S. government said, no, we can run deficits until the cows come home, and the cows will never come home. Or as Dick Cheney said when he was running the country as vice president, deficits don't matter anymore. Well, they do, but that's beside the point. If you only focus on monetary policy and you ignore the fiscal policies and you ignore the fundamental supply-demand imbalances in the real economy, it's as if you're sitting on the front porch waiting for somebody to break into your house through the front door. And meanwhile, they've come in through the kitchen door out back, which you left unlocked, and they've cleaned your house out. So that's why commodity prices are down. Interest rates are up, and the broader financial markets look at what's going on and saying, we think the Fed and other monetary authorities will win. I put it in writing so that you could review it. Now let's talk about silver inventories, because another nonsensical thing that you keep hearing is that inventories are falling so sharply that the silver price is going to rise. And you have these guys saying, oh, the world's running out of silver. The world is not running out of silver. There are billions and billions of ounces of silver in refined form above ground. Most of it is held by investors. If you bought our Silver Yearbook, we have the data in there. These are COMEX registered and eligible inventories. And you can see that the blue part, registered, has fallen sharply. I'll show you a breakout of that in a second. And total inventories have fallen. Total inventories have fallen from about 400 million ounces to about 330 million ounces. Registered inventories have fallen from about 150 million ounces down to about 33 million ounces. And, I was misrepresented by somebody somewhere on the dark side of the internet by saying that I said that when inventories got to 30 million ounces, it would represent, it would have an effect on the price. What I had actually told that person, because he asked nicely in private, was that inventories probably would have to get below 30 million ounces before they could possibly have any effect on the prices. And the reason I say that is take a look at the registered inventories here. They have spent most of the period of time since the mid-1960s at or below 30 million ounces. And they didn't really have much of an effect on price. And that's the important part. Paying attention to the inventories and thinking that they're going to have an effect on price is bad thinking. Okay, let's take a look at just registered inventories. Yes, they have fallen back to where they were in 2015 to 2018, when the silver price was, $13, $14, $15 an ounce. Yeah, so those low inventories back then really didn't have too much of an effect on the price. And then you could see in 2018, 2019, 2020, into 2021, silver inventories rose sharply to record levels. Registered silver inventories on COMEX rose from less than 30 million ounces to 150 million ounces. And the price of silver rose from $15 to $30 very briefly, $20, $25 for most of the period of time when the inventories were high. So you could say more accurately that high inventories correlate with high silver prices and that low inventories correlate with low prices. So if you want to be one of those believer guys, you would say, I want to see inventories rising. Reality is that it doesn't happen. Go back to the 1990s. Take a look over here in the 1990s. 130, 110, 115 million ounces of silver inventories, registered inventories, falling down to about 33, 35. And the price of silver, by the way, traded between $3.50 and $5.50 throughout this period. But you saw a massive decline, much bigger in percentage terms than back here. Probably not. Very large decline, no price response. Very large increase, no price response. Very large decline, no price response. The price started rising around 2005 after inventories had risen and fallen back to somewhat nominal level. And the price rose very sharply from 2005 to 2011 as inventories rose and then fell. Inventories are not a presaging factor on gold. This is the total COMEX reported inventories, registered and eligible, and the price of silver. He who finds a corollary in this doesn't know how to look for a corollary. And let's go back and look at just registered inventories and prices. And again, you can see it up and down with inventories, and the price is flatlining. Oh, the price starts rising as inventories rise. Price comes down as inventories are falling. Rise, they keep falling. Fall, the price keeps falling. Moves sideways. Inventories start rising and the price of silver rises. Inventories start falling and the price of silver falls. Anybody who tells you that silver inventories are falling to critically low levels, the world is running out of refined silver, is lying to you. And most of them know that what they're telling you is not true. Some of them probably actually believe it because they've never read a book on silver in their lives. But most of them consciously are trying to mislead investors. There is plenty of silver around. There's plenty of silver to meet the demand on the COMEX. The decline in reported inventories and registered inventories and the decline in London inventories has nothing to do with the world running out of silver. If you look at those London inventories once again, London only started reporting that in 2016, went from 950 million ounces up to about 1.4 billion ounces, 1.35 billion ounces, during a period of time when the price of silver initially was low and then started rising. I won't bore you with the details. We bore our paying clients with those details as to what was going on that caused inventories to rise sharply in New York and in London and in Switzerland and in Shanghai during that period of time. And I will tell you this, the decline in inventories in London and New York do not reflect a massive flow of silver out of the United States and London to Russia. That's another thing that's just like a pipe dream that somebody's made up. That silver, some of it's being used in fabricated products in North America, Europe, and in China, where they still manufacture a lot of stuff. Some of it's being moved into unreported inventories by investors. It's not one big investor, and it's not one big bank. The silver inventories, the critical thing to remember is this chart. Rising and falling silver inventories do not presage rising and falling silver prices. If you're listening to and investing based on somebody who's saying that to you, you're going to lose money. You can go to our website. You can read all about us. There are videos on YouTube that go back several years on a range of topics. You can buy some of our research. You can become a retail investor client. You can become a wholesale investor client. You can buy our research and read about the things I've talked about here, as well as all sorts of other things. In the meantime, have a good weekend. Take care of yourself and those around you, and watch out because the world is a treacherous place.